Good day, fellow investors. Timing the market beats timing the market might be the wrong way to look at things, especially in the current environment. So I discussed the P-ratio cycles that happened over time in history, must-watch video. There were comments, if cycles work in 10-20 years, am I saying not to be in the market for 10 years? Other comments, just own a local total market index funds, add to the position consistently, whether the market is up and down, shift then into bonds. And yes, that has worked greatly over the last 40 years. But we don't know whether that will work again greatly in the next 20-30 years. And my message here about investing is to think about what investing is. And that's with what we're going to start. And there is this predominant mantra that time in the market is all that matters. And yes, it did matter, as over the last 40 years you had 2 positive cycles and just 1 relatively negative cycle from that valuation perspective that we discussed in the P-ratio video. Check that out. And that's why things work. But if you had 2 negative cycles in 40 years, then you would be thinking completely different now. And who has seen those cycles evolve is Warren Buffett, Berkshire Hathaway. He has now $200 billion in cash, getting a 5.3% yield from the US government directly to his pocket. Compare this 5.3% with the 1.29, 1.3 S&P 500 dividend yield, and in case that this becomes too low for the market and they require a 5% yield, the stock market crashes 75%. And 75% is not something that those just investing in marketing index funds, being in the market, is something that they expect. What's the alternative? Well, the alternative is investing through owning businesses. This is something that I discussed a year ago. And you will say immediately, yes, Sven, you discussed it a year ago, says it was okay, it was 22 euros, now it's 17, so the market went up 30% in that period. You are down 10%, okay, 5%, as there has been 1 or 2 dividends. But that is something that really explains investing. Are you investing for the rewards the business is giving you, or because stocks just go up? This business, food business, will likely keep on giving those dividends over time, likely even grow and play in its niche. Therefore, it is in my diversified portfolio, for example, and I'm compounding, reinvesting those dividends into other businesses, and I constantly get those dividends and earnings and growth to reinvest and compound. Something that you, with 1.3%, you're not getting. You are betting everything on stocks will always go up. I prefer owning businesses and to bet on that my compounding machine will always go up. If I have trickled your interest, check my research platform, 21-day money-back guarantee. You can check everything, and I'll see you in the next video.